Hi, I'm Doug Carroll. Welcome to Bond Yields Explained. In this session, we'll discuss a variety of different yields commonly encountered by fixed income market participants. The objective of this module is to provide viewers with some insight into the calculation, interpretation, and application of various types of yields. Before beginning the presentation, let me provide a brief overview of what to expect over the course of the module. The presentation will begin by introducing concepts and terminology related to yield. That's a bigger issue than it may initially seem, as the word yield is used to imply a number of related but distinctly different concepts. The first part of the session will focus on sorting through those different meanings, as well as some of the implications for assessing the relative attractiveness of different fixed income securities. After that conceptual introduction, the presentation will shift to a more technical perspective. The presentation will address a number of different measures of yield commonly used in describing and assessing the value and relative attractiveness of different securities: nominal yield, current yield, yield to maturity, and yield to call. The greatest emphasis will be placed on yield to maturity, one of the most widely used as well as one of the most misunderstood concepts in the fixed income business. For each of the yield measures reviewed, that segment will start with a discussion of what that specific yield measure tries to quantify, segues to the methodology for calculating that yield, then wraps up by showing how market participants interpret and apply the insights provided by that statistic. Perhaps the best way to begin a presentation on bond yields would be with the definition of yield. So what's the meaning of the word yield? Unfortunately, the word yield has a number of different, though somewhat related, meanings. Confounding things further, many authors and speakers are responsible for spreading that confusion. In some cases, they've not carefully sorted through and clearly separated in their own minds the distinct different meanings, their tangled understanding then reflected in their words. But in many cases, it's purely a function of the word yield having numerous different but related meanings, and authors or speakers not choosing the words as carefully as they might. Adding an appropriate qualifying word or phrase can make very explicit the specific meaning. Without the qualifying word or phrase, the meaning of the word yield can only be discerned by the context in which it's used. So, what are the meanings associated with the word yield? It is a word that is encountered in many professions and many walks of life. While there are other meanings associated with yield, the use is most analogous to the way yield is employed in the fixed income markets is as a reference to the amount of production, output, or income. Farmers will talk about crop yields, chemists about the product of a chemical reaction, physicists about the strength of a nuclear explosion. In the fixed income markets, there are four different, though not unrelated, meanings associated with the word yield: rate of return, interest rate, cash flow, and current value. There are a few other obscure references, but these four are the meanings most commonly associated with the word yield in the fixed income markets. Rate of return is a common implication of the word yield when it's used by itself. One might hear an asset manager talk about their portfolio having earned a yield of, say, 4.55% in the last quarter. Clearly, when used in that fashion, it's a reference to rate of return. On the other hand, sometimes the word yield is simply a reference to some interest rate. And there are numerous interest rates that have the word yield in the name of the interest rate: yield to maturity, yield to call, yield to par option, yield to worst, nominal yield, current yield. I'll stop there, but I can probably name at least another half dozen interest rates that have the word yield in the name of that interest rate. So oftentimes the word yield is simply a reference to one of those interest rates, most commonly used as a shorthand for yield to maturity. Occasionally, yield is a reference to cash flows. In recent years, traditional fixed income investors have looked outside of the fixed income markets in search of better returns, given the extremely low interest rates on high-quality debt securities. Frequently in recent years, I've heard statements to the following effect by fixed income portfolio managers. With interest rates so low, I've been considering investing in high dividend yield stocks or real estate investment trusts, REITs, because they offer very attractive yields, and I might even get some appreciation while I'm collecting those attractive yields. In this case, yield is a direct reference to the cash flows coming from the investments, the dividend yields on those equity securities. Yield is also widely used as an expression of current value. Many securities are normally quoted on a yield basis. That's the convention for quoting money market instruments, for example. And even for securities that by convention are usually quoted on a price basis, in many instances market participants will find it more insightful to assess a security's relative value on the basis of its yield to maturity rather than its dollar price. Even when bonds are quoted on a yield basis, trades settle for a specific dollar amount. A given yield quote implies one and only $1 price for the bond so quoted. Though at times it carries other meanings as well, these are probably the four most widely associated meanings with the word yield. Unfortunately, many authors and speakers have not made clear distinctions between these various meanings in their own minds. The diverse meanings are related to one another, making it easy to confuse and conflate the different concepts. Even where the author or speaker has a good grasp of the nuance, their words must be chosen carefully. The fact that yield has so many diverse meanings is a recipe for confusion. Periodically, I have occasion to review introductory level texts on fixed income markets. All too frequently, I will encounter a passage where the author has used the word yield 3 times in the same paragraph, each time intending a different meaning. For someone new to the fixed income market, reading that passage is probably more confusing than helpful. No doubt some of the readers will have a sense that the author is implying something different with each use, but it will be very hard for someone new to the fixed income markets to have a clear understanding of what they have just read. Let's consider in detail a number of different yields commonly encountered by fixed income investors. 4 commonly cited yields encountered on individual bonds are nominal yield, current yield, yield to maturity, and where appropriate, yield to call. Of course, the last of that quartet would only apply to callable securities. For non-callable securities, only the first 3 measures would be pertinent. Let's illustrate these different yield measures for a specific bond. For each of the yields to be reviewed, we'll first demonstrate the calculation and discuss the implications or insights of the number on a standalone basis. Ultimately, the focus will shift to what can be discerned by looking at the pattern of the different yields on an individual bond, as well as the insights into relative value on different bonds by comparing them on a yield basis. Let's use this hypothetical bond to calculate nominal yield, current yield, and yield to maturity. A $100,000 par value bond from the infamous XYZ Corporation, having a 4.5% coupon rate, which matures in exactly 20 years and is currently trading at 92% of its par value. The nominal yield would not have to be calculated if one has a bond's description. Nominal yield is just a fancy way of saying coupon rate. To compute the nominal yield, divide the annual coupon payments by the bond's par value. For the XYZ bond, first compute the annual coupon payments by multiplying the 4.5% coupon rate, 0.045 in decimal terms, by the $100,000 par value, resulting in annual coupons of $4,500. Then divide the $4,500 of annual coupon payments by the $100,000 par value to find a nominal yield of 4.5%, which is the same as the coupon rate, as it should be, as nominal yield and coupon rate are synonymous phrases. So the nominal yield expresses the coupon payments as a percent of the par value. Of course, that is an important consideration, but beyond that, by itself, the nominal yield gives little insight about a security's investment characteristics. Nominal yield is not adjusted for coupon frequency. Yet investment returns would be different depending upon whether a bond has a single annual coupon or pays semi-annual, quarterly, or monthly coupons. Since the nominal yield is simply the total coupon payments over the course of the year as a percent of the par value, it understates interest income, as cash flows would likely be reinvested as quickly as possible. Next up, current yield. Current yield is computed by dividing the annual coupon payments by the market price. For the XYZ 4.5s, annual coupon payments equal $4,500, as calculated previously in the nominal yield example. To compute the current yield, divide the $4,500 of coupon payments by the market price of $92,000, resulting in a current yield of 4.89%. The insight drawn from current yield. It informs potential investors as to the income per annum, directly from the bond, as a percent of the cost of the bond providing the income. That formulation is just a restatement of the current yield computation. The income to the investor directly from the bond itself is the sum of the coupon payments. To receive that income in the future, an investor would have to pay the current market price of the bond. Like nominal yield, current yield captures only a portion of the return to the investor. Just as with nominal yield, the current yield would not reflect any reinvestment income. So the true annual interest income to an investor would be higher than implied by the current yield for any coupon bond that compounded more often than annually. Current yield also ignores what is perhaps the biggest determinant of period returns in the short run, at least on intermediate and long-dated securities, the impact on the bond's price of changing interest rates. While current yield often gets significant exposure in basic level fixed income texts, in most market segments it is not a measure weighed heavily by most investors. Especially in the taxable sectors of the bond market, investors are more likely to focus on total return. A large percent of fixed income portfolios are managed to generate attractive returns relative to some benchmark index. For such investors, current yield is of lesser importance. Current yield is most valued as a measure of a security's attractiveness in those markets where buy and hold strategies are pursued by a meaningful portion of investors. One such market sector is the municipal bond market. Munis are covered in detail in another module, but deserve a few comments here to complete the explanation. For most investors, municipals are purchased for the tax-exempt interest income. A number of market factors cause municipal bonds to be less liquid. Issue sizes tend to be small. The market size is limited, as most munis are only attractive to in-state investors so as to qualify for the tax exemption. Small trade sizes because of significant individual investor participation. Because municipal bonds are relatively illiquid, they are relatively expensive to trade. Also, if sold at a gain, the capital gain is taxable. Because buy and hold characterizes the behavior of a significant portion of investors in the municipal bond market, it is the one sector where fixed income professionals pay serious attention to current yield. It is the only fixed income market sector where individual investors are a significant factor. These investors are often buying municipal bonds for the tax-free cash flow on investment that will likely be held significant periods of time, if not all the way to maturity. Current yield measures the return as such investors will realize it. Let's now turn to yield to maturity. Of the yields discussed here in detail, yield to maturity is probably the most important because it is commonly used by market professionals to convey information about bond values. Unfortunately, despite its extensive use, yield to maturity is perhaps the most widely misunderstood concept in the fixed income business, a problem exacerbated by the misleading explanation of the concept given in most introductory level texts. All too often, yield to maturity is not recognized as industry jargon. Some take the words at face value, yield to maturity being just a phrase composed of English language words, and the meaning of the phrase being nothing more than an aggregation of the meaning of the individual words. That's not the nature of jargon. Industry jargon is not subject to such a simple, straightforward interpretation. Professional educators often malign jargon. More than a few times I've heard teachers say something like, "Don't use jargon, explain what you mean." That's fine for an educator in a classroom, but misses the point regarding why jargon evolves. Professionals in any industry develop a time-efficient way of communicating very complex issues. With specialized industry jargon, a single word or brief phrase is used as a shorthand way of communicating more involved concepts or complicated procedures. Unfortunately, many basic book writers are oblivious to such issues. The common misinterpretation is understandable given the words involved. Recall one of the common interpretations of the word yield. It's often used to mean rate of return. So unsurprisingly, many people new to the market or not familiar with fixed income industry jargon will infer the meaning of the phrase yield to maturity via the following chain of reasoning. If yield means rate of return, then yield to maturity must mean rate of return to maturity. Nearly every introductory level book on fixed income markets define yield to maturity how? As the rate of return to an investor who buys a bond and holds it to maturity. A few moments of serious reflection should disabuse one of the likelihood that that would be true for any coupon bond. By way of example, think of a new issue 10-year T-note, which today, in early 2015, is trading at a yield to maturity of approximately 2%. In large part, the return on investment, if held to maturity, depends upon the reinvestment income on the first 19 coupons. Unless those reinvestment rates are known with certainty, it would be impossible to know the rate of return to maturity. Of course, the interest rates at which those future coupons will be reinvested are unknowable. Though it's usually described as a measure of expected return, the only thing a bond's yield to maturity precisely quantifies is the security's current market value. Yield to maturity is the name of the interest rate that expresses the current market value of a bond. Yield to maturity is defined as the discount rate that equates the present value of the future cash flows, the future interest and principal payments, to the current price of the bond. The formula before you is the mathematical framework for making that computation. This initial formulation is the generic version expressed in symbols, stating the price, the left-hand side of the equation, equals the present value of the future cash flows, the right-hand side of the equation. Each of the C's represents a coupon payment. C sub 1 for the first due coupon after the purchase of the bond, C sub 2 for the second due coupon, etc., all the way through C sub n for the nth or final coupon, received at maturity, at which time all of the principal or par value would be returned as well. Each of the denominators on the right-hand side of the equation is 1 plus I raised to a power, where the power represents the amount of time until the receipt of the cash flow in the numerator. Time here is expressed in coupon periods. To compute the yield to maturity, insert the price on the left-hand side, the cash flows on the right-hand side, then solve for the single value of I that results in the two sides of the equation being equal. As this is the same bond used for discussing nominal and current yield, the variable values have already been determined. The percent of par quote of 92 indicates a dollar price of $92,000. The 4.5% coupon rate means $4,500 per year, which results in $2,250 semi-annual coupon payments. The second version of the formula has those details for the XYZ bond inserted into the appropriate places. The only variable for which there is not a value are the I's. Yield to maturity is computed by solving for the single value of I, the single discount rate that causes the present value of the future cash flows to equal the price. That rate, sometimes called a periodic rate, would be annualized by multiplying by the number of compounding periods per year. So, how is the yield to maturity computed? How does one solve for I? Yield to maturity is not computed by a simple algebraic manipulation of the price-yield formula, somehow separating out a single I on one side of the equation, having all the known values on the other side of the equation, then performing all the operations in the appropriate sequence to calculate I. The computation is not that straightforward. Nor are there any closed-form solutions that would permit a direct computation of I. There are closed-form solutions that allow one to estimate yield to maturity, but the only way to precisely calculate yield to maturity is via an iterative process. Let's describe that iterative process. Replayed here is the price-yield formula with the price and cash flows inserted. The one value not yet determined is the I. The iterative process begins by assuming some value for yield to maturity, which is then divided by the number of compounding periods per year to convert the annual yield into a periodic rate. That periodic rate is then plugged into the formula as the value of I, which is then used to compute the present value of the cash flows. The present value of the cash flows is then compared to the market price. If the two are equal, the final step would be to annualize the periodic rate to get the yield to maturity. Almost certainly the first guess will not be right. The process would be repeated until finally arriving at a value of I that results in the two sides of the equation being equal. Unless you're already familiar with the process, that abstract description might not be clear. Let's illustrate the process with an example. Start by assuming a yield, convert that into a value of I, then based on that value of I, compute the present value of the future coupon and principal payments. Let's start by assuming a yield to maturity of 5% as the initial guess. The convention for expressing yields, or interest rates more generally, is to do so on an annual basis. However, whenever you're calculating values or cash flows, fixed income market conventions require use of periodic rates. As the example bond was assumed to pay semi-annual coupons, divide the annual yield of 5% by 2 to determine a periodic rate of 2.5%, or 0.025 in decimal terms. Plugging 0.025 into the formula for the value of I makes each divisor 1.025, which generates a present value of the cash flows of $93,724.31. That present value is above the actual price, which means that too low of a discount rate was used in the first iteration of the process. So try again. This time using a higher yield to maturity, say 5.2%. Again, that annual rate needs to be converted into its periodic equivalent. Dividing 5.2 by 2 gets a periodic rate of 2.6%, or 0.026 in decimal terms. Thus, every divisor on the right-hand side of the equation becomes 1.026. That would generate a present value of the cash flows of $91,360.16. Now the present value is less than the actual price, which means the discount rate was too high in this instance. So the yield must be less than 5.2%. But now the correct yield is bracketed. It's somewhere between 5 and 5.2%. That process would be repeated until arriving at a value of I that results in a present value of the cash flows equal to the price. In this example, the value of I would be 0.025726. That would lead to a yield to maturity of 5.15%. Would that be the investor's rate of return on the XYZ 4.5s if bought today at 92 and held to maturity? Recall what's just been calculated. Not a rate of return, just the single discount rate that equated the current price to the present value of all the coupons and principal. Adjusted for compounding frequency, That's all yield to maturity is, the interest rate that equates the present value of the future cash flows to the price. We'll come back to yield to maturity a bit later in the presentation, at that point suggesting a more useful way of interpreting yield than simply using it as an estimate of future returns. But before going there, let's consider what insights we can obtain by comparing several of the yields already discussed. Specifically, what do the relative values for nominal yield and yield to maturity tell us about the price of a bond? Recall the previously computed yields for the XYZ 4.5s. Nominal yield of 4.5%, current yield of 4.89%, and yield to maturity of 5.15%. What does that pattern of values on the different yields indicate regarding the bond's price? Set aside the current yield and think about the implication for the bond's price of the other two yields. Nominal yield considers only the coupon payments as a percent of the par value. Yield to maturity considers all of the cash flows on the bond, coupons and principal, relative to the price. Consequently, unlike for nominal yield, the yield to maturity calculation would reflect the potential capital gain or loss if the security were held to maturity. So what insight about a bond's value can we get by comparing those two metrics, nominal yield and yield to maturity? In this example, the yield to maturity is greater than the nominal yield. Recall what's factored into those calculations. Nominal yield reflects only the coupons relative to par. Yield to maturity reflects the coupons, but also is impacted by the implied capital gain or loss. If the yield to maturity is greater than the nominal yield, that implies a capital gain to maturity. Absent a default by the issuer, at maturity a bond will be worth its par value. The only way an investor could get a capital gain to maturity is if the bond today could be purchased at a discount to its par value. That relationship between nominal yield and yield to maturity always holds true. By comparing the nominal yield to the yield to maturity, one can immediately discern a bond's price relative to par. As in the case just reviewed, anytime the nominal yield is below the yield to maturity, or saying the same thing another way, if the yield to maturity is at a premium to the coupon rate, the bond in question must be trading at a discount to its par value. What about bonds trading at a premium to par? Unsurprisingly, the relative value of nominal yield and yield to maturity versus price are reversed. Here again is the XYZ 4.5s along with the yields computed previously. Even if the price were not given, one could infer the bond was trading at a discount to par because the yield to maturity was above the coupon rate. Let's consider a generally similar bond, one from the same issuer with the same time to maturity, but one significant difference, a much higher coupon rate. Assume there is another XYZ bond issue outstanding that also matures in 20 years, but this other bond has an 8% coupon and is trading at 135% of its par value. What are the nominal yield, current yield, and yield to maturity for the XYZ 8s? The nominal yield is the same as the coupon rate, so the nominal yield is 8%. Though it could be calculated by dividing the $8,000 of annual coupon payments by the $100,000 par value. The current yield would use the same $8,000 of coupon payments but would be divided by the $135,000 market price, so the current yield would be 5.93%. Using the iterative process to find the single value of I, then multiplying by 2 to convert the periodic or semi-annual rate to an annual basis, the yield to maturity would be 5.15%. Note the different pattern across the various yields just calculated for the 8% coupon bond versus those same yields on the 4.5% coupon bond considered previously. For the 8s, the nominal yield is above the yield to maturity. This is the reverse situation of what was seen for the 4.5% coupon bonds. The 8% nominal yield is above the yield to maturity of 5.15%. A yield to maturity below the coupon rate, or nominal yield, implies a capital loss to maturity. Assuming no default, at maturity a bond is worth its par value. Thus, a capital loss to maturity would be expected if a bond were trading at a premium to its par value. What about yield to call? Yield to call is a close relative of yield to maturity in that the methodology for computing the two is essentially the same, the iterative process described previously. Naturally, yield to call only applies to callable bonds. Assume the XYZ 4.5s due in 20 years are callable in 3 years at a 2.5% premium to par. In other words, a call price of 102.5 or 102.50 using decimal percent of par quotes. Here's the formula for computing yield to call. It has the same general structure as the formula used to compute yield to maturity, though clearly there are a few important differences here. Whereas yield to maturity takes into account the cash flows all the way to maturity, yield to call is based on the cash flows only up to and including the first call date. Note the formula. The final coupon payment is indicated as C sub FC. That is the coupon due on the first call date. And rather than par value, the call price is due at call. Some callable bonds are callable at par, but the vast majority of bonds that are callable at the issuer's option require the issuer to pay a call premium for the privilege of retiring the bond early. To solve for yield to call, plug the cash flows and price from the sample bond into the formula, that detailing shown in the second version of the formula in the middle of the page. Since it's the same bond, though now callable, with the same coupon, there are the same $22.50 periodic coupon payments each period prior to call. The final cash flow is $104,750, that amount being comprised of the $2,250 semi-annual coupon payment, the $100,000 par value, and the $2,500 call premium required if the bond is called as of the first call date. That sets the problem up. The solution requires the same iterative process that was employed with yield to maturity to solve for the single value of I that equates the present value of the cash flows to the price. That process results in a value for I of 0.041594. That is the periodic discount rate that would cause the two sides of the equation to be equal. As this is a semi-annual pay bond, that periodic rate would be multiplied by 2 to render the rate on an annual basis, resulting in a yield to call of 8.32%. Before going on, let's consider yield quotes on callable bonds. Non-callable bonds, if quoted on a rate basis, are quoted by their yield to maturity. Callable bonds will be quoted either by yield to call or yield to maturity. What determines which will be quoted? Industry jargon would express it as yield to worst. Be careful about the interpretation of that phrase. The actual meaning of the phrase is to quote the lower of either yield to maturity or yield to call. So for callable bonds quoted on a yield basis, both yields need to be determined, and then whichever is the lower of the two will be the yield quoted and reported on trade confirmations. While that rule might seem arbitrary, there is a rationale for using that convention. It turns out that by quoting the lower of the two yields, the quoted yield is reflective of the issuer's likely behavior. If yield to maturity is the lower of the two, it's because the bond is trading at a discount to its par value, which means market interest rates are above the coupon rate on the bond. In other words, if rates at call were the same as they are today, the issuer would not likely call the bond. Conversely, if yield to call is the lower of the two, that almost certainly means the bond is trading at a premium to its par value. And for the bond to be trading at a premium to its par value means that market interest rates are below the coupon rate on the bond. Naturally, if that condition still obtains as of the first call date, Market rates far enough below the coupon rate would induce the issuer to retire the bond early via a call. That would likely happen even if the issuer did not have available cash on hand. If need be, the issuer could sell a new bond at the lower market interest rate and use the proceeds of that offering to retire via a call the higher coupon bond previously issued. Let's return to yield to maturity. Earlier discussions touched on some of the common misunderstandings and misinterpretations, but most of the focus was on the computation of yield to maturity. Let's now reconsider yield to maturity from the perspective of an insightful way to interpret that statistic. In part, that entails addressing why it can be problematic to think about yield to maturity as a rate of return. However, the ultimate goal is not only to understand yield to maturity as an alternative way of expressing the current value rather than using price, but beyond that, to understand how yield to maturity can be a more effective way of understanding what an investor would be paying today for the expected future cash flows. A good place to start is by focusing on what yield to maturity actually is. Despite the fact that most books describe it as a rate of return, yield to maturity is in a literal sense nothing more than a discount rate, as we saw earlier when discussing its computation. Unfortunately, the phrase discount rate creates some room for confusion, as that phrase is used to describe many different interest rates. One use of discount rate is as the name of the interest rate used to express the market value of T-bills. Consider how a dealer quotes bills. Here's a sample dealer's two-sided quote. 1.27% bid, 1.25% ask. Even though quoted on a rate basis, all trades settle for a set amount of money. Presumably, both parties to the potential trade understand the dollar values implied by those rate quotes. That's one meaning of discount rate, the interest rate that expresses the value of T-bills. Another discount rate is the interest rate at which banks that are members of the Federal Reserve System can borrow from one of the regional Federal Reserve banks. Say J.P. Morgan Chase decided to borrow from the Federal Reserve Bank of New York. Such loans are said to be made at the discount window, a reference to the fact that the borrower must provide eligible securities as collateral, but cannot borrow their full value, only a discounted amount. J.P. Morgan must repay the loan with interest to offset the liability. The interest rate that the Fed is charging J.P. Morgan on the loan at the discount window is referred to as the discount rate. Yet another discount rate, both the interest rate on loans by the Fed to member banks and the interest rate that expresses the value of T-bills, are called the discount rate. They are different interest rates that happen to have the same name. The phrase discount rate was encountered earlier in the presentation when discussing the calculation of yield to maturity, though in that context it's a more generic use of the term. Discount rate is used as a general descriptor here as opposed to being the name of a specific interest rate as in the previous two examples. Recall the earlier discussion regarding the computation of yield to maturity. The process involved finding the single interest rate that would cause the present value of the cash flows to equal the price. Yield to maturity is that single discount rate multiplied by the number of compounding periods per year. If yield to maturity is actually a discount rate, how come so many books and market participants describe or think of yield to maturity as a rate of return? Part of that goes back to a simple misunderstanding of the implications of the phrase yield to maturity, which was addressed earlier. If one thinks of yield as meaning rate of return, it's a seemingly logical extension to interpret the phrase yield to maturity as meaning rate of return to maturity. As was discussed previously, that inference is based on an overly simplistic interpretation of the individual English language words that comprise the phrase yield to maturity. By its nature, the meaning of industry jargon is not discernible by combining the dictionary meanings of the words in the phrase. How likely is it that the discount rate based on today's price and contractual cash flows will equal the rate of return on a bond investment held all the way to maturity? Consider the two calculations, yield to maturity versus rate of return to maturity. On the left is the bond price yield formula, which was used previously to calculate yield to maturity. The formula states the price is equal to the present value of the future cash flows discounted by the yield to maturity expressed as a periodic rate. In the earlier application of the formula, given the price and cash flows, the yield was calculated by solving for the single value of I that caused the two sides of the equation to be equal, then annualizing the result. How is rate of return computed? The formula to compute the annualized rate of return is on the right-hand side of the exhibit. To compute an actual rate of return, one needs the value of the bond or bond portfolio both at the beginning and end of the period for which the return is to be calculated. Ending value divided by beginning value equals 1 plus total return. Raising that number, 1 plus total return, to the 1 over n power, where n represents the number of years between the beginning and end of the time frame over which the return is being computed, equals 1 plus the annualized rate of return. Subtract the 1, which reflects the initial value of the investments. What remains is the annualized rate of return over the period. When computing portfolio returns for performance reporting purposes, the period beginning value is the market value of the portfolio at the beginning of the year or the quarter. The ending value is the market value of the portfolio at the end of the year or the quarter. The ending value would reflect any price changes on both realized and unrealized gains and losses, as well as any cash flows received and any reinvestment income on those cash flows. Computing the rate of return to maturity on a bond is a bit more problematic. The beginning value is easy enough, today's price. The ending value is where the issue arises. The ending value should reflect all cash flows received over the life of the bond, plus any reinvestment income on those cash flows received prior to maturity. On a fixed coupon bond, the contractual cash flows over the time to maturity are known. Absent a default by the issuer, the timing and amount of the cash flows can be accounted for. However, since future interest rates cannot be predicted with any certainty, the reinvestment income that would be earned over the time to maturity is unknowable. Thus, the ending value needed to compute the rate of return to maturity is unknowable. What's the likelihood that the yield to maturity at which a long-dated bond is trading today will equal the annualized rate of return on that bond if held to maturity? Saying the same thing another way, what's the likelihood that the single discount rate that equates today's price to the present value of the contractual cash flows annualized will equal the realized rate of return, which will be heavily impacted by unpredictable future reinvestment rates? Let's illustrate these issues using the bond previously employed to calculate yield to maturity. The XYZ 4.5s trading at 92, maturing in 20 years. On the left, the exhibit shows the price yield formula, fleshed out with the numbers reflecting the terms of the XYZ bond and its price. On the right of the exhibit is the rate of return formula completed to the extent possible. Per the earlier commentary, rate of return to maturity on a coupon bond is unknowable. Even if we assume no default, the ending value needed to compute return cannot be known today because of the uncertainty about the reinvestment rates on all the coupons received prior to maturity. The $100,000 par value and the $90,000 of cumulative coupons, $4,500 a year for 20 years, will be realized as long as there's no default. There is no way of forecasting with certainty today the rates at which the 39 coupons received over the 20 years prior to maturity will be reinvested. Of course, there's 40 coupons over the 20 years, but the final coupon is received right at maturity, so would not be able to generate any reinvestment income over the life of this bond. How likely is it that the pattern of reinvestment rates would be such that the rate of return to maturity would equal the yield to maturity at the time an intermediate to long maturity bond is purchased. The probability is approximately 0. Many fixed income related texts make a number of questionable assertions about what is assumed when calculating yield to maturity. The only assumption actually used in the computation of yield to maturity is that all future cash flows are paid in full in a timely fashion. In other words, no default. Not because that is what market participants really believe, rather it's necessary so that all market participants interpret a given yield to maturity to imply the same dollar price. Unfortunately, most books use some variation of the following when explaining yield to maturity. Yield to maturity implies reinvesting all the cash flows at a rate equal to the yield to maturity. Yield to maturity assumes a flat yield curve. Rate of return to maturity would equal yield to maturity at which the bond was purchased if all the cash flows received prior to maturity are reinvested at that same rate. Yield to maturity makes no assumptions either about the reinvestment rate or the shape of the yield curve. An approximately correct rendering of the preceding misconceptions would require inverting the typical formulation. That is, if you want to interpret yield to maturity as a rate of return, you have to assume a constant reinvestment rate, or a flat and non-moving yield curve. So reworded, those statements are now approximately true, but why would one ever want to make such unrealistic assumptions? What would the rate of return to maturity be if a bondholder were to reinvest all the coupons at a reinvestment rate exactly equal to the yield to maturity? Without delving into the mechanics of the actual calculation, it turns out that for an annual pay bond, the rate of return to maturity would equal the yield to maturity at the time of purchase. On a semi-annual pay bond, because of the impact of compounding, a slightly higher rate of return would be earned. Using the XYZ 4.5s, if all the cash flows were reinvested at the 5.15% yield to maturity, the rate of return to maturity would actually be 5.21%. So yes, assuming a constant reinvestment rate equal to the yield to maturity at the time of purchase would result in a realized rate of return approximately equal to the yield at purchase. Of course, there's numerous problems in viewing yield to maturity that way. Perhaps most prominently, when was the last time U.S. markets experienced a protracted period of stable intermediate to long-term interest rates? Not since the 1960s. Given that rate volatility has been the norm for several generations, I would suggest that any investment concept premised on the assumption of stable interest rates is of questionable value. A few times previously in the presentation, it's been mentioned in passing that it's more insightful to think of yield to maturity as an expression of the bond's current value rather than as a future rate of return. Instead of expressing the current value with a price, expressing the value with an interest rate. For people new to the fixed income markets, it often seems a needlessly complicated way to express value. In actuality, it's a more efficient way of expressing value in terms of what is being paid today per dollar of future cash flow. Let's consider yield to maturity from that perspective. Recall the bond price yield formula. It's more commonly referred to simply as the bond pricing formula. Yet this is the very same formula used previously to calculate yield to maturity. The fact that both a bond's price and its yield to maturity are calculated using the same formula should be a strong indication that both price and yield must be two ways of expressing the same idea, the bond's value. Consider a specific example based on the bond used earlier to calculate the various yields, the XYZ 4.5s trading at 92, maturing in 20 years. Below the bond's description, you see the price yield formula with the contract details inserted into the appropriate locations. As in the earlier illustrations, you have the $22.50 semi-annual coupon payments, a final cash flow of $102,250 as all the principal is returned along with the final coupon, and the timing of those cash flows indicated by the exponents and the divisors. As shown, the formula provides no price or yield. What information would be necessary to compute either the price or the yield? Recall the earlier application of the formula. Given a price of $92,000, through the iterative process we were able to calculate a yield to maturity of 5.15%. Alternatively, if the yield was known, the price could have been calculated by converting the yield to a periodic rate, which would be used to discount the coupon and the principal to a present value, which is the industry convention for calculating the dollar price of a bond. To calculate either a bond's price or its yield requires knowing the value of the other in advance. A bond's price can only be calculated if the yield to maturity is already known. Calculating a bond's yield to maturity is only possible with a known price. If neither of them are known, neither could be calculated. So not only do both price and yield come from the same formula, the value of one is needed to calculate the other. This should reinforce the idea that price and yield to maturity must be two different methods of conveying the same information, the current market value of the bond. What happens if neither the price nor the yield to maturity is known? Then neither could be calculated in the sense described so far, which is based on fixed income industry conventions for relating price to yield for quotation and trade confirmation purposes. In those contexts, to calculate the price, the yield must already be known. To calculate the yield, the price must be known. Again, consider the price-yield formula with the contract details of the XYZ 4.5s trading at 92 due in 20 years inserted into the appropriate locations. Recalling basic algebraic concepts, one equation with two unknowns means there is not a single solution to the problem. To calculate the yield of 5.15% required knowing the price was $92,000. To calculate the price of $92,000 with allowances for rounding errors required knowing the bond was trading at a yield to maturity of 5.15%. This is not to say that a bond's price or yield couldn't be estimated. They can be estimated based on various analytic techniques, but that's something different than calculating a price or yield for trade or trade reporting purposes. One approach to estimating a bond's value would be to get the yield to maturities for a number of similar bonds. Assume the XYZ 4.5s had a BBB rating. An analyst would seek current quotes or recent transaction values on other BBB rated bonds with around 20 years to maturity. Ideally, bonds issued by similar-sized companies in similar industries, though seldom will there be a large number of really similar securities. And it will not likely be as straightforward as discounting the cash flows on the XYZ 4.5s by the yield to maturity on a single other 20-year BBB rated bond, nor a simple average yield to maturity from a representative sample of such securities. It would be necessary to consider the specific characteristics of the XYZ bond being evaluated compared to the characteristics of the similar bonds in the representative sample. To estimate the XYZ bond value, take the average yield on the sample group of bonds, then adjust the yield estimate higher or lower to reflect the relative value of the XYZ bond versus the sample. The XYZ company is perhaps a slightly better or slightly worse credit risk. Perhaps the XYZ bonds are expected to be a little bit more or a little bit less liquid. Once an appropriate yield has been determined, it can be used to determine the present value of the cash flows consistent with the estimated yield. That's not actually computing the price. It's estimating the value of the XYZ bond based on bonds in the representative sample for which we do have yields. Alternatively, an analyst can estimate the price, then use that estimated value to infer the appropriate yield to maturity. A common methodology for estimating a bond's fair value is to discount each of the individual cash flows not by a single interest rate as is done for bond pricing, but rather discount each of the cash flows by an interest rate appropriate given the timing and risk of the individual cash flows. That methodology uses a type of interest rate known as spot rates. So here you see the right-hand side of the price yield formula with a significant difference. You'll note that each of the periodic rates in the divisors, the i's, are now subscripted. So we'd use I sub 1, the one-period spot rate, to estimate the value of a one-period cash flow. We'd use I sub 2, the two-period spot rate, to estimate the value of the second-period cash flow, and so on and so forth all the way out to the final cash flow due at maturity. Since that's 20 years or 40 semi-annual periods in the future, we'd want to discount that by a 20-year rate or an I sub 40. Summing the discounted present value for each of the cash flows provides an estimated fair value. The estimated fair value substitutes for the price on the left-hand side of the price yield formula, then solve for the yield to maturity consistent with the estimated fair value. Again, this is not actually calculating the bond's yield. Based on an estimate of fair value, which becomes a proxy for price, one can calculate the yield to maturity consistent with that estimated price. So far, the discussion of yield to maturity has focused primarily on how it's computed and why it may be problematic to use yield to maturity as an estimate of future returns. Let's now focus on how to interpret yield to maturity as an expression of the current value of a bond. Recall the price yield formula. We're played here that it might be used as a framework for understanding yield as a measure of current value. Consider a situation where an investor is trying to assess the relative attractiveness of two somewhat similar securities. Securities having the same credit risk and same time to maturity. Assume the investor is analyzing two bonds with 3 years to maturity. Bond A with a 5% coupon, priced at $972.91 per $1,000 par, and Bond B, which has a 9% coupon and is priced at $1,081.26 per $1,000 par. In terms of certain substantive elements, the bonds are quite similar. Same credit risk and same time to maturity. Yet because of the significantly different coupon rates, the two bonds have very different prices per $1,000 par. The investor would like to buy the bond that represents the better relative value. So which of these bonds is cheaper? Cheaper in the sense of the meaning conveyed when used by a bond trader or bond portfolio manager discussing the relative value of a bond. Used in that context, cheap would not mean 972.91 is less than 1081.26, nor would cheap mean bond A is trading at a discount to par. Likewise, rich would not mean 1081.26 is more than 972.91, nor would rich be a reference to bond B trading at a premium to its par. So if a bond being designated as rich or cheap is not a direct reference of one bond's dollar price to another bond's dollar price, nor a bond's dollar price versus its par value, what must rich or cheap be an allusion to? Think about the reason investors buy bonds. At the most basic level, bonds are purchased for their cash flows. Rich or cheap is a way of referencing the relative cost today for each dollar of future cash flow. Richness or cheapness can be based on a comparison of one bond to another bond, or a comparison between a bond and some benchmark of fair value. A bond would be considered cheap if it could be purchased today for less money per dollar of future cash flow versus the cost per dollar of future cash flow on another bond it's being compared to. Alternatively, cheap could also mean an investor could buy a bond today for less money per dollar of future cash flow than some benchmark of fair value says it should be worth. Similarly, rich means you're paying more today per dollar of future cash flow. Again, that could be in the context of comparing one bond to another bond, or versus some benchmark of fair value. In a bond-to-bond comparison, the bond designated as rich means an investor would pay more today per dollar of future cash flow on the bond trading rich versus the bond it's being compared to. Alternatively, a bond would be rich if it cost more money today per dollar of future cash flow versus some benchmark of fair value. When could one discern richness or cheapness in the sense described here by a simple comparison of one bond's dollar price to another bond's dollar price? The only situation in which richness or cheapness could be discerned by comparing dollar prices would be when every bond you're comparing is exactly the same in all regards excepting issuer. Not just the same credit risk and time to maturity as in this example, but all the bonds would also have to have the same coupon rate, same embedded optionality, the same compounding frequency, and so on. When an investor is considering a range of investment opportunities in the fixed income market, how likely is it that every bond under consideration has exactly the same maturity, same coupon, same credit risk, same optionality, etc., etc.? Well, of course, just about never. In nearly all instances, investors are likely comparing bonds that have at least some differences. Sometimes investors may be comparing relatively similar bonds, as in this example, where the only significant difference was in coupons. More typically, many things differ: maturity, credit risk, optionality, and so on. So how does an analyst recognize when a bond is rich or cheap? By plugging the contractual cash flows and prices for both bonds A and B into the price yield formula, and computing their yield to maturities would provide an answer. Exactly how does yield to maturity express the current value, and how does that enable investors to identify a security as rich or cheap, as was just discussed? Again, recall how yield to maturity is computed. The bond price yield formula specifies how price and yield are related to one another. The amount and timing of the contractual cash flows detail the right side, the market price on the left. Initially, the only unknown is the periodic discount rate, the i's in the denominator on the right-hand side. Solve for I via the iterative process described earlier, which when annualized by multiplying by the number of coupon periods per year determines the yield to maturity. So why solve for a single interest rate? What information does that single discount rate convey? Using a single interest rate can't be the right way to value a series of future cash flows dispersed over time. Using a single interest rate to value a stream of future cash flows would imply the belief that the risks related to the individual cash flows are the same across all periods. It's highly unlikely that the risk across all cash flow periods would be exactly the same for any intermediate to long-term bond. As a specific illustration, consider the XYZ 4.5s maturing in 20 years that was used to explain the method for calculating yield to maturity. It would be near impossible to make a reasonable case that the default risk over the 6 months until the receipt of the first coupon would be exactly the same as the default risk over the 20 years until the receipt of the last coupon in principal. Similarly with inflation risk. The inflation risk over the next 6 months is likely very different than the inflation risk over the next 20 years. Bond pricing requires discounting all the cash flows by the same rate, the periodic rate implied by the quoted yield to maturity, so that all market participants interpret the yield quote the same way, to imply the same dollar price. Estimating fair value would require using interest rates that reflected the risk and timing of the individual cash flow that the rate was being used to value. Such rates, known as spot rates, were introduced earlier in the session. The single rate solved for when computing yield to maturity is not a rate used to value future cash flows. Remember the method for computing yield. Yield to maturity is the price re-expressed as a single interest rate. Yield to maturity is not the interest rate to be used to value future cash flows. Rather, yield to maturity is the interest rate that expresses the value of future cash flows. Yield expresses the relative cost or value of future cash flows in terms of what one would have to pay today per dollar of future cash flow. Expressing value on a rate basis effectively puts different bonds an investor may be comparing on a common footing. That's necessary when contract terms such as coupon, maturity, credit risk, etc. differ, causing the cost per dollar of future cash flow on the different bonds to be near impossible to discern by comparing dollar prices. Plugging the price and cash flows into the price yield formula and solving for I gives a relative measure of the price paid today for those future monies. An interpretation of yield to maturity in the context of comparing two bonds. If the bonds are trading at different yields to maturity, the bond trading at the higher yield has a lower cost today per dollar of future coupon and principal payments. The bond trading at the lower yield has a higher cost today per dollar of future cash flow. Of course, that does not imply investors should always buy the cheaper bond. A cheaper, that is higher yielding bond, may be cheaper for a reason. And is it cheap enough? High yield securities are always cheaper than equivalent maturity treasuries. High yield securities, also known as junk bonds, will always trade at a yield to maturity well above similar treasury securities. The question is whether the yield spread is large enough to compensate investors for the greater default and liquidity risk of investing in junk bonds. But be clear on the information contained in the yield spread. The difference in yields is not the difference in expected returns on the two securities. Remember what goes into the yield to maturity calculation. The higher yield on the junk bond versus the benchmark treasury security indicates how much less an investor would be willing to pay today per dollar of contractual cash flow on the high yield security compared to the cost per dollar of contractual cash flow on the treasury security. What about bonds A and B that were brought up earlier? Which of the two is cheaper? That's near impossible to spot from inspection if all one has are the contract terms and the prices. Clearly, bond B gives the holder more money over the 3 years to maturity, but bond B has a significantly higher price. Bond A costs less per $1,000 par, but pays its holder less money. Naturally, it's more insightful when assessing relative value to understand the cost per dollar of future cash flow than the price per $1,000 par value. Inserting the price and cash flows into the price yield formulas and solving for I provides that insight. The formula for each of the bonds is shown below the contract descriptions. Solving for I results in a discount rate of 0.03 or 3%, or a yield to maturity of 6% for both bonds. Understand the implications of the two bonds having the same yield. It's not that the two have the same expected returns. That would depend on any changes in credit ratings, the rate at which the coupons are reinvested, possible sale prior to maturity, and various other factors. Note that none of those foregoing factors entered into the calculation of yield to maturity for the two bonds. Equal yields to maturity means that bonds A and B have the same cost today per dollar of contractual cash flow. Unfortunately, the vast majority of books discuss yield to maturity as if it were a rate of return. Some of the reasons for that misunderstanding and misinterpretation were addressed earlier. Even though most books make a direct connection between yield to maturity and rate of return to maturity, repeating an untruth more frequently doesn't make it any less untrue. It's clear from the computation of yield that many factors affecting return do not enter into the calculation of yield to maturity. Yield to maturity is often used as an estimate of future returns, but one should be very careful about using yield to maturity in that fashion. The vital information contained in yield to maturity is the current market value of the bond. It's the same information as contained in the market price from which the yield is computed. But by expressing value on a yield basis, that information is rendered in a fashion that makes it much easier to compare the cost per dollar of future cash flow on different securities. That should seldom be the only consideration an investor takes into account when selecting investments, but understanding the relative cost of future cash flows is obviously one of the most important considerations when analyzing fixed income investments.